The retail apocalypse continues to reshape America's shopping landscape, with fast fashion brands bearing the brunt of changing consumer preferences and economic pressures. In an unprecedented wave of closures, 15 major American fast fashion retailers are scaling back their brick-and-mortar presence, signaling a dramatic shift in how we shop and what we value in clothing. Forever 21, once the crown jewel of fast fashion, is leading this retreat from physical retail. The company filed for Chapter 11 bankruptcy in September 2019 due to declining sales and high rent costs. At its peak, Forever 21 had 800-plus stores worldwide. After bankruptcy, it closed around 350 stores, including many in the United States. After emerging from bankruptcy in 2020, the company announced plans to close an additional 100 stores across the United States in the months ahead. This comes as no surprise to industry analysts who've watched the brand struggle to compete with online retailers and adapt to growing consumer demand for sustainable fashion options. It was bought out by Authentic Brands Group, Simon Property Group, and Brookfield Property Partners, allowing it to stay in business. H&M, while not strictly American, but with a massive United States presence, is following suit. The Swedish fast fashion giant is shuttering 250 stores across America, particularly in lower-performing shopping malls. This strategic retreat reflects a broader trend of retailers abandoning traditional shopping centers in favor of high-traffic urban locations and digital channels. The company's decision comes after years of inventory management issues and growing criticism over its environmental impact. Express, a popular American fashion retailer known for trendy and business-casual clothing. However, the brand has been struggling financially in recent years. Express announced in early 2024 that it may have to close more stores due to ongoing financial difficulties. The company laid off 10% of its workforce in 2023 to cut costs. This decision follows years of declining sales and mounting competition from online retailers like Shein and Boohoo. The brand was delisted from the New York Stock Exchange due to low stock value. Express struggle highlights the challenges traditional retailers face in maintaining expensive physical locations while competing with digital native brands that operate with lower overhead costs. American Eagle Outfitters, despite maintaining relatively strong brand loyalty among Gen Z consumers, isn't immune to these pressures. The company plans to close 100 underperforming locations while investing heavily in its digital infrastructure. This hybrid approach reflects a growing understanding that physical retail must evolve beyond mere transaction points to survive in the modern marketplace. Charlotte Russe, which already went through bankruptcy in 2019, is continuing to slim down its retail footprint. The brand, known for its affordable young women's clothing, is closing an additional 75 stores across the country. This second wave of closures suggests that even post-bankruptcy restructuring isn't enough to guarantee survival in today's challenging retail environment. Rue 21, another teen-focused retailer, is following a similar path. After previously closing hundreds of stores during its 2017 bankruptcy, the company is now planning to shutter another 50 locations. This ongoing contraction reflects the broader challenges facing retailers who primarily target younger consumers, who increasingly prefer to shop online or through social media platforms. Urban Outfitters, while not traditionally categorized as fast fashion, has been caught in the same retail downdraft. The company is closing 30 stores across its various brands, including Anthropologie and Free People, focusing instead on developing its digital channels and remaining physical locations in prime shopping districts. Gap Inc.'s Old Navy division, long considered one of the more resilient fast fashion retailers, is also scaling back. The brand plans to close 75 stores across North America, focusing particularly on underperforming locations in smaller markets. This retreat marks a significant shift for a brand that was once seen as largely immune to the pressures facing other retailers. Rainbow Shops, a lesser-known but significant player in the budget fashion space, is closing 100 stores nationwide. This chain, which has traditionally served urban communities with affordable fashion options, is finding it increasingly difficult to compete with online retailers offering similar products at comparable or lower prices. Francesca's, the boutique-style fast fashion retailer, continues to struggle despite previous restructuring efforts. The company is closing an additional 60 stores, focusing its resources on digital expansion and remaining locations in high-traffic areas. This decision reflects the broader industry trend of consolidating physical presence while building out online capabilities. Wet Seal, which has already gone through multiple rounds of closures and ownership changes, is shuttering another 40 stores. This latest contraction suggests that even scaled-down operations are struggling to find sustainable footing in today's retail environment. Fashion retailer Agachi, once a popular fast fashion brand, particularly among young women looking for trendy and affordable clothing. However, it struggled financially and filed for bankruptcy twice, first in 2018 and again in 2019. After its second bankruptcy, the brand closed all its stores and ceased operations. While it had a dedicated customer base, it is no longer an active or widely recognized brand in the fast fashion industry today. The company's struggle to maintain profitability in physical retail locations mirrors the broader industry challenges of high operational costs and changing consumer preferences. Joyce Leslie, a regional fast fashion retailer primarily operating in the Northeast, is closing all remaining stores after decades in business. The company couldn't keep up with online competition and changing shopping habits. In January 2016, Joyce Leslie announced it would liquidate all its stores and permanently shut down. This complete exit from physical retail represents the most extreme outcome of the current retail transformation, where even long-established regional players cannot survive the shift to digital commerce. Deb Shops, another regional player that has struggled to adapt to changing market conditions, is closing its remaining physical locations. This closure marks the end of another legacy retailer that failed to successfully navigate the transition to digital-first commerce. These closures represent more than just individual business decisions. They signal a fundamental shift in American retail. The fast fashion model, built on rapid turnover of trends and physical store presence, is being challenged by several factors. First, there's growing consumer awareness of environmental and ethical concerns surrounding fast fashion. Young shoppers, in particular, are increasingly choosing sustainable and second-hand options over traditional fast fashion. Digital transformation is another key factor driving these closures. Online-only retailers like Shein have demonstrated that physical stores aren't necessary for success in fashion retail. These digital native brands can offer lower prices and faster trend responses without the overhead of maintaining store networks. Economic pressures are also playing a role. Rising retail rents, increasing labor costs, and the need for significant investment in digital infrastructure are making it difficult for many retailers to maintain extensive store networks. The COVID-19 pandemic accelerated these trends, pushing more consumers toward online shopping and making many question the necessity of physical retail locations. The impact of these closures extends beyond the retailers themselves. Shopping malls, many of which relied on fast fashion brands as anchor tenants, are struggling to fill vacant spaces. Retail workers, particularly in smaller markets, are facing job losses as stores close. The supply chain that supported these retailers, from manufacturers to logistics providers, is also feeling the effects. However, this retail transformation isn't entirely negative. Many brands are using store closures as an opportunity to reinvent themselves for the digital age. They're investing in improved online experiences, developing more sustainable product lines, and reimagining the role of physical stores in their business models. Some are experimenting with smaller format stores, pop-up locations, and experiential retail concepts that better align with modern consumer preferences. The future of fast fashion retail likely lies in a hybrid model that combines strategic physical presence with robust digital capabilities. Successful retailers will need to offer seamless integration between online and offline channels while addressing growing consumer concerns about sustainability and ethical production. The current wave of store closures, while challenging for many stakeholders, may ultimately lead to a more sustainable and consumer-focused retail landscape. As we watch these 15 brands scale back their physical presence, it's clear that the American retail landscape is undergoing a fundamental transformation. The question isn't whether fast fashion will survive, but rather how it will evolve to meet the changing demands of modern consumers. The retailers that successfully navigate this transition will likely emerge stronger, while those that cling to outdated models risk joining the growing list of retail casualties.